In this video, we're going to look at the VIX futures to show an example of what we might expect for one-day forward returns in backwardation. That's a spread of the VIX front month less the VIX second month over 1, or rather greater than 0 in this case, and in deep contango as well. So to access the volatility futures, you can go to the volatility drop down, and by default it's going to come up with a spread between the front month and the second month future. So again, above 0 in the spread indicates backwardation. That just says that the front month is over the second month future. And then a deeply negative number is a condition which we call Contango, and that's just the normal everyday market condition, business as usual type market condition. So we've noticed in the past, sort of since the correction started, there's been multiple periods or multiple days where the spread has been in backwardation. What does that mean for the next day volatility? Let's go back 15 years and test it. So when we go back 15 years, we can see immediately that the spread has been as high as 20 points, and that was achieved in the Great Financial Crisis in 2008. And then as high as like 10.5 points in 2020. So we'll filter on that range. And again, we can see that the spread only backwardates during the most volatile periods, and it's an indication of an issue that needs to be fixed now. It's not an expectation of volatility that's going to be lower in the future. When you run a back test, by default, the app calculates a 20-day forward return. On the 20-day forward return, you can notice that the volatility kind of expands quite a bit. And we should also notice that on a one-day basis. So in deep contango, we notice very narrow realized volatility, and as we go into backwardation, we see volatility expand quite a bit. And we can also see that on the distribution. So on the one-day distribution, it's much less peaky, and there's a much greater probability of large negative returns and large positive returns. And then if we go to just deep contango, so let's call that minus 3 points to minus 5 points. That's just not really common at all. So let's go minus 2 points. Okay, we've got a bit more data there. Let's go minus 1 point. Okay, that's quite a bit of data. So, yeah, we capture the least volatile part of the distribution. And we can see that on the probability distribution, the peaks, or the peak of the Contango filter is much higher, and the probability of greater negative losses and greater positive losses is lower as well.